Good afternoon, everyone. I'm Stacy Scott, and I'm here with Graham Wickham, President and CEO of Wickham Financial and Insurance Services. And it's time again for our weekly wrap up. Graham, what can you tell us about the markets from last week?
Well, I think it's the same story. Volatility, right? I think the market tried to have a big rally on Friday. Maybe some optimism that Russia, Ukraine were coming together, some sort of maybe resolutions or peace talks. But at the same time, we really saw crude. Crude oil futures shot up to 130. We haven't seen that in so long. Drifted back down to 109. So if you've gone to the pump lately and gassed up your car or whatnot, it is a lot higher than it was. So that commodity with the geopolitical events has been on the rise, probably likely to stay elevated for the foreseeable future. So that's definitely putting pressure, added volatility on the markets in terms is that going to cause a recession globally, not just in Europe, but will that come across over to the United States? So that's kind of a question. That's kind of really what the markets are really trying to digest right now. We did have a print with inflation that came out to about 7.9%. So inflation is still on the rise, right? Not as quick, not as fast, but it's still moving up. So how aggressive does the Fed need to be when they meet? How quick, how fast? Again, it's never been the question that interest rates are going to go off to kind of cool this market down or economy down a bit. It's just the pace is the big question, right? And I think that's really been the biggest concerns. You know, the markets have been down for the last 5 weeks. So it's been, a pretty challenging market over the last month or so.
I understand. Well, with that said, I understand you have some market statistics to share with us.
I do. And everyone loves stats, right? Don't we
Absolutely.
all? Right. So let me throw my attempt out here, some statistics. I have a little cheat sheet in front of me, so bear with me if I'm looking around. But, I wanted to try to, bring this to our audience is that what's coming to the surface now are bear market conversations, recession type conversations. What's the likelihood? What's the likelihood? And let's put some things in perspective, right?
Okay.
When the indices go down 10% or more, that's a correction. They go down 20% or more, we get into what's called a bear market, right? And let's think about bear markets. Stocks lose on average about 36% in bear markets, right? But in bull markets, they're up in about 114%. That's a huge difference. Now, let's think about this. Bear markets can be painful, but overall, bear markets are positive the majority of the time. Think about this. The market is up 78% of the time over the last 92 years. So what is the moral of this story that I'm throwing here? At least the stats, right? We're going to have to experience bear markets. We're going to have to experience corrections. It doesn't mean that they're going to last an extended amount of time. We have a bear market about every 3.6 years. So that's the frequency in between that time frame, right? So we have to expect some of these bear markets. A bear market doesn't necessarily indicate an economic recession, right? We have the NASDAQ down 20+%, the S&P, the Dow, the small caps, they're down 10% plus right now. But not necessarily does it always indicate a recession. We've had 26 bear markets since 1929, but only 15 recessions during that time. So not necessarily does a down market lead to a recession. It puts pressure on the economy, but not necessarily pushes us into a bear market.
Very interesting. Well, we'll see how this one plays out. And thanks so much to you for that information. And thank you to our viewers for joining us today and every week for our weekly wrap up. We'll look forward to seeing you again next week and hope everybody has a great week and a good weekend. Thanks so much.
Thank you. Take care.
Bye-bye.